Good morning and welcome this morning to Trading Futures. There's the opening bell, which means that it's time to get started here. A couple of quick reminders. Certainly, first of all, the reminder that we've got the great Connie Hill out there in the chat helping out to keep the conversation flowing. Connie's a 20-plus year veteran of the financial market. She is there to help answer your questions along the way. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'll be taking you through this futures journey this morning, which means that we need to cover a couple of quick safety items as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular account type or security or strategy or anything else. Remember that futures and futures options trading involves substantial risk. It is not suitable for all investors. It requires separate trading authorization. Read the risk disclosure statement for futures and options prior to considering any futures transaction. Make sure that you are aware of the fact that futures trading requires a futures margin, also known as a performance bond, both an initial margin and a maintenance margin. We'll talk a little bit about those as we get into this discussion this morning. Remember that investing involves risk, including the loss of principal. Some products and strategies, that loss of more than your initial investment can take place. And certainly futures is one of those areas where that can happen. We're going to be using the thinkorswim desktop software platform today, specifically the paperMoney version of the platform. Remember that the paperMoney version does not do certain things that the live trading version does. It's a great learning environment. It's a great practice sandbox, if you will. But remember, as you move your practice from paper trading to live trading, there are going to be some differences, especially in the area of order fill prices, as well as some of the tools that are available on the platform. Now, speaking of that, stop orders when it comes to trading futures, not guaranteed in execution. In fact, stop orders that generate a market order will be substituted by the exchange at the time of activation for an exchange designated limit order based on a protection range instead of that originally triggered market order. That means that that order may not fill, just like a stop limit order may not fill in a fast moving market. Now, we're going to talk today, hopefully, as we get into this discussion, about some virtual currency derivatives. Those involve unique and significant risks. Make sure that you read the NFA investor advisory and the CFTC customer advisory about those particular products. Remember that virtual currency is a digital representation of value that functions as a medium of exchange, but does not have legal tender status, at least not yet. And as we get into this discussion, remember that we're going to be using technical analysis. It's not the only way to look at the market. It is theoretical, as is fundamental analysis, as is probability analysis. Past performance, no guarantee of future results. So let's jump in here really quick and get into this discussion. Take a look at what's going on this morning. The futures are up a little bit as far as the equity futures. Still seeing the RSI tailing off a bit. A bit of a bearish divergence going on here between the RSI, the relative strength index, that momentum indication, and the futures themselves, seeing a slightly up start to the trading session here this morning as we get into this discussion of the /ES, taking a look at the NASDAQ. NASDAQ breaking out a little bit here. Not quite the same bearish divergence in the NASDAQ that we're seeing in the S&P 500 in the broad market. In fact, the RSI moving to new higher highs here, roughly about that 75 mark. That's not an indication that it can't be bought anymore. Remember that overbought, oversold name. Those monikers on the RSI tend to be pejorative. They tend to make people think that, boy, if that RSI is up in that overbought, that there's nobody else buying, that it's not getting pushed higher. It's really just an indication of some extreme validation of that upward trend that you're starting to see, or likewise extreme validation of a downward trend. So price can stay moving higher. The RSI can stay up in that upper range or lower range for a long period of time, especially when whatever the instrument that you're looking at is trending. And I'll tell you what, you talk about a strong trend, and take a look at the /NQ, really from the end of March through April, and I mean, look at the significance of this in terms of a probability standpoint. One of the things, and Connie, I think, has taught this before in some of her candlestick classes. I know she's talked about it. I know Barb's talked about it. But you talk about the number of up candles in a row, and you take a look at this NASDAQ and you look at kind of the strength of this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14 up candles in a row really doubles kind of the max probability function of that. You start to look at some of the candlestick patterns that suggest that 6 candles in a row in an upward direction is highly improbable. 7 candles gets really, really improbable. 14 in a row? Holy cow. So not suggesting that that's going to stay, but not also not suggesting the fact that because it's been moving higher and you see very few red candles here in this mix, that it has to come down. There's nothing that says that it has to come down. This could continue to move strongly to the upside. And in fact, we're still in the middle of the earnings season, so there is some upward speculation going on here. Russell 2000 in this particular case, again, 7 candles in a row and then a red candle as a pause. Starting to see maybe a little bit more of a tail off here in terms of the RSI, but a little bit of a breakout here today, both price-wise and RSI-wise. Albert says, what are candles? Wow. I'll tell you what. I'm going to ask Connie to go out there and find one of our webcasts. I know Barb's taught this. I know probably Connie's taught this as well. Just our Getting Started with Technical Analysis Candlestick Patterns or Candlesticks class. So candles are simply a display of information, price information, high, low, open, and close, but filling in the move in between those. And so you start to see that move. If we were to zoom in on this, you could see each one of these candles represents the high price, the low price, the open, and the closing price for each aggregation period. Now, this is a 1-year daily chart, so each one of these candles represents a 1-day time frame. If we were to change this to a shorter time frame, you're going to see that each one of those candles represents a smaller period of time. In fact, we're going to look at 5-day, 5-minute candles here in just a few minutes as we start to look at some of these individual names. But starting to see this little bit of a breakout this morning in the Russell 2000. I'm glad I zoomed in on this because I think this gives me kind of a little bit more perspective here about what that breakout looked like. We started to see it happen yesterday. We got a gap up and a rally, and then it pulled back just a little bit. Now we're starting to see a gap down and a rally today, breaking above this range, starting to see that move to the upside. Albert, thank you for asking the question because, again, this is a good reminder for everybody, I think, that's here. Remember that there are some of you who have been doing this for a long period of time, and so you may just simply have a good, solid understanding of these terms that we talk about and these concepts. And for those of you that are brand new, we want you to feel welcome as well. We want to make sure that everybody has good understanding. So if I do go back and I explain some things along the way, recognize that that's probably a good idea to review sometimes what's going on. And for those of you that are brand new, and I do talk about some things that are maybe a little bit more complex in this discussion, especially today when we're talking about futures, recognize that, there are some things that you probably have to learn and spend a little bit of time in these webcasts. So it's a good idea to remember that we want to be a little bit like Goldilocks and the Three Bears. We're going to get there to where everybody feels comfortable, hopefully, with the discussion that's happening. But the Russell 2000 here, starting to see that move to the upside. Now, a couple of other things that I want to look at while we're right here on the futures grid. I want to look at /VX, and we're going to come back to VIX in just a minute. But actually, I'm going to do VIX as a whole, just instead of the /VIX. I'm going to look at VIX, the VIX itself. We can start to see VIX is falling a little bit. The RSI, the momentum indicator for VIX, coming down a little bit as well. Thank you, Connie, for finding that candlestick video. I appreciate that. Starting to see the VIX bleeding off. That means that generally Options on the S&P 500 are getting a little bit cheaper. That means that there is generally a little bit less, if you want to think about it, hedging activity or fear going on in the market. Not that there's not fear because we're still relatively elevated, although we're at a 17 handle. So we're below both the 200 period and the 50 period moving average for the VIX. We'll see what that means for the volatility index, but we're starting to see some downward movement in the volatility index. So let's do this. As we start to see this futures market moving and start to see maybe fear bleeding off, that would suggest, at least initially here at the outset, that we look at forward slash RTX, right? Forward slash, oops, let's come back over here. Let's go to there, and then let's go back here. Forward slash RTY, there we go. We're starting to see that breakout kind of across the board. Maybe this is a little bit of a risk on day. Well, what does that mean? Risk on. We hear that all the time. Risk on, risk off. Risk on generally means that growth assets, things like the technology sector segment of the market, tend to be moving higher. So we seem to see, certainly today, be in kind of a risk on mode. That would suggest that we maybe are seeing things like the dollar, for instance, forward slash DX, the dollar index, maybe moving down just a little bit here. Maybe as somewhat of a defensive move or anti-defensive move, if you want to think about it from that standpoint. Risk on versus risk off. Risk off tends to be more defensive. So we would typically tend to see things like gold moving a little bit lower, and we have been seeing gold moving a little bit lower in the last couple of days. Let's see what forward slash 10Y, what bond yields, the 10-year interest rate or 10-year yield futures are doing, and they're backing off a little bit here. They've been making kind of this, if you want to think about it, kind of this rounded bottom type of pattern, but the potential is here for a double top type of move, maybe back down into that 4.2 range or so in interest rates. So it's always a complex puzzle to try to put this together and see what's moving and what's not moving. So one of the ways that we can do that is to just kind of scan through like we've done. I've put together this quick futures grid looking at the three kind of broad market futures, forward slash, what did I have? Forward slash ES. We've got forward slash NQ, forward slash NQ. There's the NASDAQ futures, and then forward slash RTY. By the way, this grid, my futures grid, is in the description page for this particular webcast, but I'll go ahead and I'll share this with you right now so that you've got it. I like to share these out with the group, but remember that anytime we share anything, it is for illustrative and educational purposes only, and it's not guaranteed as to time or accuracy. So now you've got this futures grid, which is those three broad market indices. But we're seeing the Russell moving a little bit higher, the NASDAQ moving a little bit higher, ES moving a little bit higher here, VIX falling off just a bit. So the next question that I might ask in this particular case is, what is something that is perhaps a little bit more focused in terms of risk doing at the moment? And that's where we've got to perhaps ask the question, what's crude oil doing? And crude oil, which we've seen some exquisitely stunning moves recently. I mean, we've seen some big days in the crude oil market, is back down a little bit today. It was up around the 104 mark to start the trading session. It is now down around 102, so down almost 4% on the day. So seeing some of that risk in crude oil perhaps coming off, if you want to think about it from that standpoint. The crude oil tends to go higher when there is more geopolitical risk. Obviously, you know, the news stories have been the big dictation of this. We've seen U.S. naval warships leading some, not U.S. flagged, but U.S. bound and U.S. influenced tankers moving through the Straits of Hormuz. Um, so that is perhaps bringing these crude oil futures down a little bit. So maybe starting to see that that bleed off just a little bit here. Now, the reason I wanted to come back here to crude oil for just a second is because if we go back to the monitor tab, one of the trades that we've been looking at for some time is this relationship trade, if you want to think about it. This is a futures calendar spread. So what we did is we put this calendar spread together, and we're really kind of trading just like we would trade if you were trading an options contract. You were trading the difference between the price of one strike versus another strike if you were trading a spread trade there, or if you were trading an options calendar spread, you're trading the difference between one expiration and another. So in putting this particular trade together, we were trading the difference between one expiration price and another, because we know that crude oil contracts, as any futures contracts, have a finite lifespan. They have an expiration date. So we went short the contract that expires in June, that is the June delivery, basically. And we did that when that price was about $90 a barrel. That price then went up significantly. The expectation was it was going to come down because we were expecting that it was at the start of the ceasefire and that prices were going to go down. And at the same time, we were expecting that the longer dated contract, the one that expires out into December deliveries, was going to go up in price. Now, it did. It went from a price of $74 a barrel to $81 a barrel. And you can see where that move has happened. So the longer dated contract has gotten more expensive. The shorter dated contract that we are short, meaning we sold, got more expensive. We didn't want that one to get more expensive. We wanted that one to get less expensive. We wanted the difference between these two contracts, those contract prices, to decrease. We wanted the spread to collapse, if you will. The width of that spread to get narrower. In fact, it's gotten wider. So this trade has worked against us to a little bit. Now, here's the thing. This is working against us, but the side of this contract, the side of this calendar spread that is working against us is the one that we're short, the futures contract that we're short, which is the June deliverable. And it's starting to come down a little bit in price, which is what we want it to do. But there's been substantial movement here, and we're now down 13 days to go until that contract essentially expires and rolls off. So we could do this. We could roll this from the June deliverable to the next deliverable, which is going to be the July deliverable. But at this particular point, until we see some additional downside movement, what we may think about doing here is just simply taking off the short-dated short side of this calendar spread and leaving that long-dated contract out there to go up in price, because it's been pretty consistently doing that. And I think that's what we're going to do until we get maybe some more consistent downward movement, until that crude oil contract starts to break down a little bit and we start to see that difference between these two starting to collapse again. So what I'm going to do is I'm going to close this one down because it's been working against us. So we're going to salvage what we can out of this. And in fact, we're not going to salvage anything. We're going to take a little bit of a loss on this at this point, but that's okay because we're serving the longer term good, which is this longer dated contract maybe going higher in price. And at some point we'll potentially sell another contract against that. So I'm going to go ahead and we're going to create a closing order for this short side, and we're going to take a little bit of a potential loss here in this particular trade. So we're going to close this down and essentially flatten the short dated side of this calendar spread. So we're going to go ahead and send that off and close that one down, and now we are out. So now we are just simply long this December deliverable micro crude oil contract. Now, a couple of people are asking this question. And this is a really interesting question. So TMTM 4357 says gas stations went from $3.95 to $4.25 or even $4.50. Yet crude oil is down? What the heck is happening? So let's go over here to our charts. And I'm going to change our chart really quickly to my single grid, which is kind of my um actually, you know what? Let's do it here. Let's do it in our futures grid. Um, there it is right here in our D's right there. Futures grid with labels. And we'll look at this longer dated side. All right. So what I'm going to do is I'm going to take a look at /CL. Here's /CL. That's what crude oil has been doing. You can start to see kind of that momentum falling off here a little bit. And so crude's been falling a little bit. But you notice that it stayed up in this $85 to $110 range, and it's done that over the course of the last couple of moves. Or I'm sorry, over the last couple of months here, right? So crude oil has been staying relatively elevated, even though in the short term it's moving down. Now, the other chart that I'm going to show here is /RB. And /RB is gasoline futures. This is distilled gasoline futures. This is what's been being refined. So you notice, and if we were to do this, let's close our volume and open interest down. Let's bring this down. Just kind of squeeze these down so that you can see these a little bit. So what I'm going to do is I'm going to put on here on this chart really quick. I'm going to go to the flask icon. I'm going to do actually, I'm going to do comparison, COMP, comparison. We're going to do a real quick comparison line on this chart to the /CL, the crude oil contract. So you can see the relationship here between crude. So the purple line here is crude oil. And one of the things that you notice is generally, as goes crude, so goes gasoline. But you also notice that crude oil tends to lead a little bit. So it may take a little while before gasoline prices start to follow crude oil again. You see that crude is tending to lead. Crude's moving down, gasoline's still moving up. That's because this is crude oil. This is two ends of the supply chain. Crude oil is the input, gasoline is one of the outputs. And so in between are the refiners. And those refiners are going to pay those costs on one side and collect those prices on the other side. The longer they can collect those prices on the other side, the more profit they make. So this relationship here between input costs and output prices is often referred to as the crack spread. Cracking, catalytic cracking, is the process that is used by refineries, oil refineries, to convert crude oil into distilled products, into refined products. So it's nothing. I got yelled at years ago. This has been almost 20 years ago. I got yelled at because the predecessor to things like the Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions. The predecessor to that was a podcast that we did called The Market Cast. And on The Market Cast, we talked about the crack spread one day. And somebody called in and complained. And they got all the way up to the CEO at that time and complained about the fact that we had talked about the crack spread. And they were offended by that and didn't understand what the crack spread was. So now I'm fairly careful about explaining that. The crack spread is simply the difference between input costs and output prices of energy products. And in fact, I've got a crack spread here. I think I had a crack spread. Oh, I do. Okay. So here's the crack spread between crude oil and RBOB gasoline. This represents this relationship. Yeah, this was before thinkorswim. This relationship represents refiner profits. This is what's referred to as a one-to-one crack spread. It's the difference between input costs of crude oil, output prices of gasoline. The longer this stays higher, the more money refiners make. So Thinking about this, if you were to think about what that means, if we were to come back to our single grid and we were to look at an individual name like VLO, which is a pure play refiner, well, gosh, they've been pretty much going up and continuing to trending up, to trend up. So Valero, one of the refineries, wow, they're still moving to the upside. So, and as long as that crack spread stays elevated, they're going to continue to stay in that direction. Let's look at one other here really quickly, and this is one that's maybe a little bit more important. This is the crack spread of crude oil to heating oil, which is the proximal relationship to things like diesel fuel and jet fuel. Wow. So look, here's the interesting thing. Start to see this product, heating oil, this crack spread going down. So what's really interesting, guys? Yeah, and you're right. It is for Sam. It is for refiners to hedge risk, right? So look at this. Here's the profitability. If you want to think about this two profitabilities, look at the profitability here, meaning the spread, that refiner's profit margin, if you want to think about it from that standpoint, moving lower on heating oil, probably because of demand destruction. If you've been paying diesel prices, you know, if you've got a diesel vehicle, I actually got rid of my diesel vehicle a little while ago. But if you're paying diesel prices, you know that those have been much more expensive than gasoline. But notice this relationship here: heating oil, diesel fuel, jet fuel, that crack spread is decreasing. It's narrowing, where our crack spread to gasoline is continuing to expand. So it may very well be that refiners are shifting back out of heating oil and back to, they're going to go to wherever it's more profitable in terms of their product mix. So it may be that they're going to start pushing more gasoline through than heating oil in terms of the output product. That may suggest that in the near term, we see prices still elevated, but as they start to sell more of it, guess what happens to those prices? Those prices come down. So here's what I'm going to do. I'm going to share this with you. You can change it. This is a 40. Okay, so there are 42 gallons in a barrel of crude oil. So this relationship: 42 times the RB, the RBOB futures, minus crude oil gives you that 1-to-1 crack spread. It's putting them into a common denominator. Yeah, I can compare those two for sure. And you can create a comparison chart. You can do a side by side. You can compare them. But that's probably a topic for another day. But I'm going to go ahead and I'm going to share this grid for everybody. And I'm going to put this out here, and I'll put it in the description as well. But remember, always, these are for illustrative purposes only. They're not guaranteed as to time or accuracy. So there's that 1-to-1. Now there's other types of crack spreads. There's a 3-to-1, which is a 3 barrels of oil, 2 barrels of heating oil, 1 barrel of gasoline. There's a bunch of different compositions of those. Yeah, boy, gosh, it oftentimes happens, Rob, Indy, that when there's a lot of demand on refineries and prices are already high, they tend to have fires and things. Now, that's not at all unusual when you're dealing with things like petroleum products, but it always seems to happen at very inconvenient times for consumers. Just saying. All right, we got a bunch of other stuff to talk about here too, which is kind of cool. But let's pop over here to our futures grid one more time. You guys caught me at an interesting morning because there's a lot of stuff going on here. Well, let's pop into our futures grid once again. And the other things that I wanted to look at here really quickly, I want to look at VIX because I started to put a trade on here this morning. We'll see how it is going. /VX. And it's working for us, at least at the moment. So remember, I thought that volatility was going to go down, that volatility was going to continue to bleed off a little bit, because if this is a risk on day, that means volatility is typically falling. So this is the VIX futures contract. So my side-by-side grid here, I'll send this grid through to the chat as well. It's in the description of the webcast, so you can get it there if you're watching this on the recorded version. Remember, of course, that it is not guaranteed as to time or accuracy. But over here on the left-hand side, here is VIX. We talked a little bit about this before. So the tick size is 0.05, which means that this number right here moves in a 0.05 increment. So that's going to move from 5 to 0 or 0 to 5. When that does that, that's a $50 change in the value of this contract. The point value is going to be $1,000, which means that when this moves from 19 to 18 or 19 or 18 to 17 or so forth, that point value change is going to be $1,000. So that means the notional value is 1,000 times whatever this number is right here. Notional value of the contract, 19,450. If we want to see what the initial margin is for a trade here, click on the drop down, go to futures, and we're going to take a look at the VIX. So about $9,000 in initial margin, right? In initial margin to place a trade here. So what I did is I created this scenario here, and I just used this impulse move that VIX made this morning. This is a today's chart, 5 minutes. So Arthur, these are 5-minute candles. So every time we get a new candle here, that's another 5 minutes of time, and it's showing that price, open, high, low, high, close, or open, close, high, low within that 5-minute time frame. So what I did is I placed a trade that got us into this short position, going short when price moved below this support level that it had established. So I got kicked into the trade right here, going short, meaning trading this to the downside, short the futures contract. I put a stop order up here above this resistance level so that if it went higher, it closed the trade down at some point around there, not guaranteeing exactly where that was going to get us out of the trade, but that's the point at which we would exit if it were going against us. And then the target that I put in here was just simply duplicating this initial move that this made down to the downside here. And so that's our target, 1895. So looking at the VIX futures going lower. We are short this contract. It's kind of trending and chopping around here, but that was not at all unusual given that it was ahead of the start of the cash trading market where those those SPX options that drive the VIX index started to trade. Because remember, equity options, index options don't trade 24/7 or 24/5 like futures contracts do, 24/6.5, right? So as this starts to come online, as that cash market starts to come online, now we're starting to get some movement in the VIX futures because the VIX index is moving. And we'll spend an entire class one of these days talking about the relationship. We did, I think, a few weeks ago, talk about the relationship between whatever the underlying instrument is and the VIX futures, or whatever futures contract it is that we're talking about, that arbitrage that exists that moves futures contracts when an individual stock moves, or for instance, an index moves, and what moves an index. It's going to become a little bit easier to understand that relationship if and when the futures exchanges start to list single stock futures. They've had them before. It's rotated back now into favor. There's a consideration where some of the futures exchanges may start listing single stock futures as soon as this summer. So something to pay attention to. And we'll be on top of that as well about those new products. But starting to see VIX moving to the downside, looking for a target down here at around that 1895 range. It's not really moving much yet, but we'll see if that continues to move to the downside. Now, let's take a look at a couple of others that I wanted to pay attention to here. One was M2K. That was our micro /M2K, our micro Russell futures. And remember how I said we were looking at the Russell 2000 /RTY? and it was breaking out. We were looking at this on the longer chart and was starting to break above that, and we were starting to see that move. RSI moving up a little bit. So now taking a look at the smaller contract. Now this is the larger contract. Let's take a look at forward slash M2K, which is the micro version of this contract. The difference here is this has a much lower notional value. And if we look at our, let's go to futures, our initial margin into this is $1,177, which is substantially lower than if we were to look at so we're talking about $11,000 of initial margin for the full-size contract. The forward slash M2K, the one that we're looking at here, has an initial margin that is a tenth that. It's $1,000, a little over $1,000. So the thought process here is maybe looking for this breakout above and starting to see this kind of flag pattern breakout. Maybe this double, kind of this breakout of this double top. RSI, or excuse me, ADX has fallen off a little bit here, but we still have a fairly strong trend in this breakout. So maybe looking for a bounce. So what I'm going to look at here in terms of this move, I'm going to see if we can maybe duplicate, because remember, these are 5-minute candles. I'm going to see if we can maybe duplicate this impulse move here, this kind of flag move. We're seeing this flag breakout. So I'm going to take that, I'm going to duplicate it to the upside, and we're going to put that up here on that breakout point. And that's going to give us a target right up here at about 28.50, we'll call it 28.52 as a target. So that's going to be our target for this trade. And I'm going to go ahead and put a T there. Our entry is going to be on this breakout above this level, which we're at this point, right? And then our stop, we're going to put down here below this kind of pullback level that this made into this support mark. So if this breaks below, and we could, this is the problem, we could potentially get triggered out on some of that intraday volatility, which is, you know, that can and does potentially happen. And that's one of the risks that we need to be aware of, is that intraday volatility can kick us out of a trade. So that's the case whether we're talking about a stock, whether we're talking about an option, whether we're talking about a futures contract. So starting to see this move to the upside and that potential breakout. So I'm going to go ahead and we're going to go long this contract. I'm going to do a right click and I'm going to go buy custom with OCO bracket. So we're going to get into the trade 28.39.40. Let me see if I can move these over so that we can see this a little bit better here. 28, we're going to do this as a limit order, 28.39.30. I'm going to give it a little bit here. I'm going to give it up to 28.39.45 to get in. And then we're going to put our target here to sell it if we go up to 28.52. 28.52. Whoops. 28.52. We'll make that 45. We'll make that good till canceled. And then we're going to make our stop here 28.25. 28.25 is going to be our stop. 25 if this goes down to the downside. And that's going to be a stop market. Remember, if that generates a market order, that's going to be worked as an exchange designated limit order. So there is the possibility of some risk there in getting out of that trade at a stop market. Whoops. I got to make that zeros. Zeros. There we go. Because remember, the minimum increment is 0 there. So now we've got our stop and our target and our stop. We're going to go ahead and get into the trade here and see if we can get in 28.40. I've got to adjust this already because it has already started to move on us. 28.41. See, as I've been talking, this has been moving again, well, in our favor if we can get into the stupid thing instead of me talking, right? So let's put this in our futures group. We'll click on send. We'll fire that order off. And we got in. Now we are long this contract. And boy, it is risk on at this point, it seems, at least in the short term. Now we are in this contract and it is moving to the upside. There you go. Doink. Yeah. Okay. I'll say the doink part. There we go. All right. So starting to see that move to the upside. One more thing I wanted to look at real quick here. while we're talking about this is /MBT. This is a virtual currency derivative. This is the micro Bitcoin futures, and this is actually a setup that I was looking at before, and this breakout above this resistance level at 81.40, 81.470 or so. But what I've realized is it's starting to back down a little bit here. We're starting to see this move to the downside. So in terms of getting into this particular trade, and I was looking at getting in this in terms of a longer term trend trade and making this move at least to the upside here to maybe the 85-100 or even further, and looking at this, taking this as a trend trade. So notice something here. The /MBT, this is 1/10 the size of the big contract. Tick size is 5. So this significant digit, the end digit here in this price, is our tick size. The tick value, every time that moves, that's 50 cents. If this moves a point, that is 10 cents. And the risk in this contract is that times there. That's our notional value. This is 1/10 that size. We look at our initial margin here in MBT, it's $2,000. That's gone up a little bit in the last little while. If we were to look at BTC, Bitcoin futures, that's 103,000. Initial margin, you got to put up 100 grand just to initiate that trade. So the /MBT, and again, I'm not making a recommendation about what contract or what size or anything else. Just look at the notional value difference and the initial margin difference in this particular trade. So I'm going to go back over here to this one, and we're going to look at this. What I may do is put on a buy stop here that says, stop, wait, don't do anything until this in fact breaks above this level right here and we get some upside movement. I'm going to right click and we're going to put this on. We're going to do a buy custom with stop so that this breaks out. If this breaks out above this 82.75 mark, 82,075 mark, get into the trade. If it doesn't, okay, no harm, no foul. We didn't get into the trade. But I'm going to stop this out to the downside if it goes down to 81,320 is where my stop is, right about there. And we're going to make that good till canceled. So we're going to put this on as a buy stop. Now, I have to change this from limit to a buy stop, which is stop, wait, don't do anything until it gets to that price, then buy it if it moves to that price or better. And we're going to click on confirm and send. We're going to put this in our futures group. Read through that order. Read the freaking order, Ben. You got to read it and read it twice. And make sure that this is what we want to do. Buy it at a buy stop. And we're going to click on send. And we're going to put that order in there. So what I'm going to do real quick, I'm going to show our orders here so you can see it. There's our order to get into the trade. There's our order to stop. Once this one fills, that's going to be active. So there we go. Guys, thanks, guys. This has been fun today. I appreciate all of the great conversation in the chat. Thank you to Connie Hill for helping out. A couple of quick reminders if you want to learn more about trading futures at Schwab. Schwab.com/futures is a great place to find lots more of that futures information. If you want to pop over here to the Trader Talks webcast page. By the way, there is a survey in the chat. I happen to notice that. Do me a favor, fill out that survey. Let us know what you think. Helps us out to make these webcasts better. Click on the subscribe button here in the futures or in the Trader Talks webcast page, and then find more of our Schwab coaching. I'm going to be next in Santa Clara teaching our advanced options 2-day live workshop. But next week we've got coming up the market drive in Chicago, which I will not be at, but you find all of those events right here on in-person events. Guys, thanks very much for being here. My thanks to our great production staff, to Connie Hill, of course, and to our great reviewers. We appreciate you and everything that you do, and certainly all of you. You guys are awesome. Have a great day, everybody. We'll see you soon. Bye-bye.